Welcome back. In today's video, I'm breaking down one of the most expensive tax traps in corporate acquisitions. A real case where a company thought they were executing a completely tax-free stock merger, only to discover they owed $166,000 in unexpected federal taxes. And here's the shocking part. The IRS actually approved it. All of it. Legal. Binding. Now, before you think this only applies to Fortune 500 companies, listen up. This trap ensnares small and mid-market business owners constantly. In fact, according to the 2023 National Association of an advisor survey, approximately 47% of acquisition deals involving companies under $100 million in revenue encounter unexpected tax complications, with an average surprise tax bill of $89,000 to $340,000. Let me walk you through exactly what happened, why it happened, and most importantly, how to prevent it from happening to your company. The case study. A $12 million stock merger gone wrong. Let's call them company ABC. They're a successful software consulting firm with $12 million in annual revenue. They've been around for 15 years, built a strong client base, and when a larger tech company came knocking with an acquisition offer, ABC's founder and two minority shareholders felt like they'd hit the jackpot. The deal structure: the acquiring company would issue $12 million in new stock to the shareholders of ABC in exchange for 100% of ABC's outstanding shares. On the surface, this appears to be a classic Section 368(a)(1)(b) reorganization, what the IRS calls a tax-free stock-for-stock exchange. The shareholders' CPA and business attorney both signed off. This is clean, they said. You won't owe federal income tax on the exchange itself. The shareholders walked away believing they deferred all their tax liability until they eventually sold the acquiring company's stock. But 6 months after closing, the acquiring company's tax department flagged something. During the diligence process, they discovered that company ABC had been holding $289,000 in accumulated cash reserves. And under the acquisition agreement's working capital adjustment clause, the acquiring company was entitled to that cash. But here's where it gets interesting. They paid for it with additional cash at the closing table instead of reducing the stock consideration. That's where the trap sprung. ***, the IRC code section that triggered IT, Section 368(a)(1)(b), and the boot problem ***. Let's talk about the foundational tax law here. IRC Section 368(a)(1)(b) defines a reorganization as the acquisition by one corporation in exchange solely for all or a part of its voting stock, or in exchange solely for all or a part of the voting stock of a corporation which is in control of the acquiring corporation immediately before the exchange, of substantially all of the properties of another corporation. That phrase, solely for voting stock, is critical. It means that if you receive anything other than voting stock, and I mean anything, you could trigger taxable gain. That anything else is called boot in tax terminology. Now, most business owners understand they can't receive cash boot, but here's what most financial advisors don't explain. There are 3 distinct types of cash payments that can constitute boot and trigger unexpected tax liability. The 3 types of hidden cash payments Type 1. Direct cash boot in the transaction This is the most obvious one and the one most people are warned about. If the acquiring company says, we'll give you $10 million in stock and $2 million in cash, congratulations, you've got taxable gain. However, here's what catches people off guard. Many advisors only warn about intentional cash boot. They don't adequately explain how cash boot can accidentally occur through deal mechanics. In the ABC case, the working capital adjustment triggered this. The deal had a target working capital of $150,000. Company ABC's actual working capital at close was $289,000. That $139,000 excess triggered a payment mechanism. The acquiring company had the right to deduct that excess from the stock consideration, or pay it in cash instead. They chose cash. From a business perspective, it made sense. They didn't want to issue extra shares. But from a tax perspective, that cash payment became boot, potentially triggering capital gains tax on the shareholders. Type 2. Assumption of liabilities Let's walk through a different scenario. Suppose company ABC had $500,000 in debt on its balance sheet. If the acquiring company assumes that debt as part of the deal, that assumption counts as boot under IRC Section 357C. Here's the real kicker. If the liabilities you're relieved of exceed your basis in the assets, you've got gain, taxable gain, even though you didn't receive a single dollar in cash. According to the American Bar Association's 2023 and a study, approximately 34% of acquisition deals involve liability assumptions that aren't properly analyzed for boot consequences. The average unplanned tax liability from this type of boot: $47,000 in unexpected federal tax. Let me give you a concrete example. Imagine you founded a real estate development company. You've got $800,000 in depreciated equipment and vehicles on the books. Your basis in those assets is $200,000 because you've depreciated $600,000 over the years. The company has $550,000 in debt. An acquiring company buys your company in a stock deal and assumes the debt. The liability assumption, $550,000, exceeds your basis $200,000 by $350,000. Under Section 357C, that excess is treated as gain, and you could owe capital gains tax on $350,000 of gain without receiving any cash. At a 20% long-term capital gains rate, that's $70,000 in unexpected federal tax. Add state taxes, and you're looking at potentially $85,000, $95,000 in surprise tax bills. This exact scenario happened to a construction company owner in Texas in 2021, according to a case documented by the Texas Society of CPAs. Type 3. Contingent consideration and deferred payments. This is the most insidious type because it's often buried in earn-out clauses and seller financing arrangements. Here's how it typically works. The acquiring company says, "We'll pay you $10 million in stock today, but if the business hits certain revenue targets in years 2 and 3, you'll get an additional $2 million. On the surface, this seems fine. You're receiving stock, but the IRS has specific rules about contingent stock under Revenue Ruling 2000-5 regarding whether this contingent consideration qualifies as equity or as additional consideration. If the IRS determines that the contingent arrangement is really a payment obligation rather than a contingent equity award, it could be classified as deferred cash consideration, which is BOOT. According to a 2022 analysis by PwC, approximately 61% of all acquisition deals include some form of earn-out or contingent consideration. Of those, the IRS has successfully challenged the tax-free treatment in roughly 19% of cases where the challenge was litigated. Let me illustrate with a real-world scenario. A digital marketing agency agreed to a stock deal with an earn-out. The acquiring company issued $8 million in stock immediately, but promised up to $3 million in additional stock based on client retention rates. However, the earn-out agreement included language stating that if the earn-out wasn't achieved, the shareholders would be required to return a percentage of the initial stock rather than accept a cash shortfall. This provision, the mandatory stock return feature, triggered IRS scrutiny. The agency ultimately determined that the initial stock wasn't truly at risk, and therefore the transaction didn't qualify for tax-free reorganization treatment. The result: the shareholders owed capital gains tax on the full $8 million of stock received retroactively for a federal tax bill of $1.6 million. Y company ABS bill reached $166,000. Now, back to our original case. Company ABC received $12 million in stock, which was tax-free, but the $289,000 in accumulated cash created a problem. The acquiring company took that cash from the escrow account and paid it directly to the shareholders as a working capital adjustment. That $289,000 was treated as BOOT. But wait, there's more complexity. Within that $289,000, approximately $156,000 represented earnings that ABC had accumulated without distributing dividends. Because ABC is a C corporation, not an S corp, those accumulated earnings triggered additional tax considerations. The shareholders had a basis in their ABC stock of roughly $5 million. This varies based on their individual investments and contributions over 15 years. The gain on the stock exchange itself was approximately $9.5 million. Under the Section 368 reorganization rules, that gain is normally deferred. However, the $289,000 in BOOT triggered taxable gain recognition under IRC Section 356A. Here's how the $166,000 bill calculated. BOOT received $289,000 gain realized on the exchange, $9,500,000 taxable gain recognized lesser of BOOT or gain, $289,000 federal capital gains tax 20% rate, $57,800 state income tax, assume 5% average, $14,450 net investment income tax 8% on gains over $250,000 for high earners, $10,992 alternative minimum tax adjustment, $5,200 because the ABC shareholders had other income and AMT preferences, professional fees for amended tax planning, $12,400 estimated total, $100, $842 in federal and state taxes, plus $65, $158 in related costs and accounting adjustments equals $166,000 total unexpected cost the counter argument. Why some advisors miss this now. Some tax professionals argue that BOOT planning is straightforward. Just structure the deal cleanly and you won't have BOOT issues. But here's the reality check. In modern acquisition transactions, especially with working capital adjustments and earn-out provisions, some level of BOOT is almost inevitable. According to Merger Market's 2023 and a report, 73% of deals above $50 million include working capital adjustment provisions, and 58% of those adjustments result in actual cash settlements between parties. So the question isn't, can we avoid BOOT? The question is, how do we plan for BOOT efficiently and strategically? How to protect yourself. The 5-point prevention framework 1. Conduct a BOOT audit during diligence before you sign a definitive agreement. Work with a tax advisor to map out all possible sources of BOOT: cash at closing, assumed liabilities, deferred payments, contingent consideration, and working capital adjustments. Asterisk asterisk 2. Model the tax consequences in the letter of intent asterisk asterisk. Don't wait until closing. Build a tax model into your LOI that explicitly addresses how boot will be treated, calculated, and potentially minimized. Asterisk asterisk 3. Structure the deal consideration creatively asterisk asterisk. Consider whether seller financing, earnout structures, or liability assumption arrangements might be preferable to direct cash boot, as they may have different tax treatments depending on your specific situation. Asterisk asterisk 4. Document the reorganization status asterisk asterisk. Ensure you have written confirmation from both companies' tax counsel that the deal qualifies as a 368(a)(1)(b) reorganization, and identify any exceptions in writing. Asterisk asterisk 5. Plan for tax liability funding asterisk asterisk. If boot is unavoidable, make sure your deal consideration accounts for the tax liability. Some sellers negotiate a tax gross-up clause, where the buyer agrees to fund the tax impact. Asterisk asterisk. The bottom line